Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Welcome to Coasting in Retirement. I'm your host, Josh Knoll, and I'm joined by my co-host, Michelle Lee Melton. Michelle, how you doing?
Little frazzled,
yeah,
but getting better.
Long day at work?
A long day at work, and it's Mardi Gras season, so planning for the boom boom.
Well, contrary to popular opinion, you don't make your millions from this radio show. You actually have a real job.
I do.
Yeah, so this is your side hustle for sure.
One of them.
Well, I tell you what, we're gonna get you unfrazzled. We've got a great show today. We are recording in our brand new state-of-the-art Jubilee Studios in Daphne, Alabama. Hooray! Yes. So first, for those of you new to the show, I am Josh Knoll. I'm the owner of Gulf Coast Financial Advisors, an independent financial planning firm based out of downtown Fairhope, Alabama. We serve clients up and down the Gulf Coast. You can learn more about us on our website at gulfcoastfa.com. I will repeat that contact info several times throughout the show. As always, Michelle and I are here today to discuss financial topics relevant to those in or near retirement, living their best life along our part of the Gulf Coast. All right, Michelle, so today we're going to discuss something near and dear to all of us, income. So, folks, when you're still working and you're collecting a paycheck, generating income can be as simple as getting out of bed and going to work, right? But what happens when you're no longer working? You still need to generate income if you're like most people anyway. What are some ways to do that? So what we decided to do was create a two-part mini-series, if you will, called 5 Ways for Investors to Generate Income in Retirement. Michelle and I are going to discuss ways to use both your investment assets and possibly your real estate holdings to generate passive income in retirement. Today, we're going to discuss the first 3 on our list, and then what we'll do is we'll pick up the discussion on our final 2 next week. Part of that is the fact that we have 1 hour constraint here on our show, and getting it all 5 would be a little lengthy. Trust me, I tried. All right, before we lay out our list of 5, let's do a little short disclaimer. In no means is this basic list of 5 meant to be a complete or exhaustive list of generating income in retirement. I'll give you some examples of some rabbit holes that we're not going to go down. For example, some folks lend money, some folks in retirement lend money to the younger working class or working generation, similar to like a bank would do, except in a private transaction, for agreed upon interest rate. Well, that's generating income in retirement, but that's not something we're going to talk about on this 2-part episode. Some investors use relatively sophisticated products such as structured notes. We will probably circle back to that at some point, but definitely not on our list of 5 these next 2 episodes. The main thing is we've only got 1 hour to get all this information out. So what we're going to do is we're going to keep our list of strategies to those that should be familiar and generally accessible for most investors. Another thing that I want to do a little disclosure on as we dive into this, there is absolutely no golden ticket strategy to generating income in retirement, and all investments, no matter what anyone ever tells you, involve risk. As you're going to learn in this episode, is that most financial advisors, including me, use some combination of these strategies to help spread the risk. If you've ever heard an advisor say bucket approach, then you kind of got a general idea of where we're going with this. So let's do this. Let's lay out our 5 ways to generate income in retirement. I'm going to do them in no particular order, but just remember, if you're listening to this episode, we're going to touch on the first 3, and then we'll circle back to the remaining 2 in next week's episode. And I will tell you this, regular listeners of the show, Michelle likes odd numbers. That's why there's a 5. I like even numbers, so I will probably sneak in a bonus line item next week just to throw her off, because I like doing that. All right, so here we go. Number 1, again, no particular order, ways to generate income in retirement. First up is an investment account designed using what is called the total return approach. Number 2 is income annuities. Number 3 is real estate investment trusts, otherwise known as REITs. And then number 4 is laddering bonds and or CDs. Some of you folks that are, let's say, in your late 60s, 70s up, laddering CDs, something you might have seen your mom and dad do, so you might have some fun with that on next week's episode. And then number 5 is going to be rental properties. We're actually going to touch on Airbnb and some of the technology that has come into the rental property market. But first, what we're going to do today We're going to talk about the first three on our list. Again, those are total return portfolio, income annuities, and REITs. We'll pick up the discussion on the laddering strategy next week and rental properties, okay? Let's start first with talking about an investment account that is used to generate income in retirement. Now, I'm going to give you a warning. We're about to go to Nerdville here real quick as we describe this, because I want you to have a good in-depth, or at least reasonably in-depth understanding of what we're talking about here. Using an investment account to generate income in retirement, there's two broad ways of doing this. The first way, call it the historical way, if you will, is generally referred to as interest and dividend investing. The idea is to create interest from bond investments and hopefully dividend payments from stocks that pay dividends, or a better way to think about it, from corporations, publicly traded corporations that distribute their profits in the form of a dividend whenever they have a profit, okay? The goal of this investment style portfolio is to set up consistent payouts, monthly, quarterly, whatever you need, without selling the underlying investments to generate the income, hopefully. All right. There's a couple drawbacks to interest and dividend investing. First, just from experience, for most people's general lifestyle and retirement, it takes a fairly significant chunk of assets to generate that high of a payout. And it's just not uncommon for these interest and dividend payments being a little bit short of what is needed to cover retirees' monthly lifestyle needs. The second thing is, bond yields, or again, let's talk about what does bond yield actually mean. It's the amount of money you make off of your bond investment. Bond yields, up until recently, have been very low because interest rates have been low. Interest rates have risen, right? We're recording February 2023. Interest rates have gone up, so bond yields have gone up, making it a little more attractive for investors that are looking for yield. However, let's not get amnesia that quick. Remember, we had pretty historically low, in fact, I think historically low bond yields for a decade plus that made it really difficult for those that were relying on that strategy in retirement. Now, pivoting to dividends, you have to understand, are never guaranteed. Companies will cut, and sometimes they'll even eliminate dividend payments, because remember, that's profit sharing during rough economic patches. Often investors will start hunting for yield in these type of scenarios, which can damage the total return, there's that word again, of your investments, which eventually can reduce the longevity of your portfolio. Regular listeners of the show know that we talk about longevity a lot with this, okay? Just remember, retirement can last 20, 30, 40 plus years, decades, and your investments need to last for that time period as well. You don't want to outlive your money. So when you consider the evolution of, or let me put it this way, what I consider the evolution of a dividend and interest strategy is called the total return approach. Total return is basically a fancy way of describing a diversified portfolio of stock and bond funds, sometimes index funds. The goal with this total return approach is to balance investment gains with income production by choosing investments that are not just solely focused on interest and dividend payments like we talked about here just a minute ago, but they also may provide, because the interest and dividend type of investments are not always the best way to get growth potential. The portfolio is managed to generate income while also providing, hopefully, some room for capital appreciation and longevity. Just remember this. When you hear the retirement spending rule, the 4% rule used to be 5%, I believe, years ago, but 4% rule, that formula was based on total return investing, not income investing. So here at Gulf Coast Financial Advisors, we use a strategy that basically it falls in line with total return investing. It seeks to generate above average current income using a blend of mutual funds, closed-end funds, ETFs, and we cover a diverse group of asset classes. In this portfolio, we also may include dividend-paying common equity, preferred stock, publicly traded REITs, MLPs, master limited partnerships. We'll talk about that later. And of course, various types of bonds. The point of it is the general target range is around 40 to 50% for the total equity exposure. And then for the total fixed income exposure, we're generally shooting for around 50 to 60%. Now, this is not necessarily, you hear the 60-40, bond portfolio. Okay, yeah, call it a kissing cousin of that, if you will, but this one's a little bit more targeted. And here's the thing. I don't have time to talk about all the nuts and bolts of this type of portfolio. If you're interested in learning more about this particular strategy, why don't you give us a call at 251-333-5151. You can make an appointment there. All right, up next in our 5 ways to generate income in retirement are annuities. Let's first quickly recap the general types of annuities. Deferred income annuities, Immediate income annuities, those are often called single premium immediate annuities, which, not to complicate everything, are SPIAs, which is one of Michelle's favorite little abbreviations. So SPIAs, you'll probably hear me call immediate income annuities SPIAs from here the rest of the show. Fixed annuities, which again, Nerdville, sorry, those are typically known as multi-year guaranteed annuities, or MIGAs, because everybody's got these cute little abbreviations. And then you got fixed index annuities and you got variable annuities. We absolutely don't have time to break down each type of annuity. So what we're going to do is we're going to focus on the three types of annuities in this episode: deferred income annuities, single premium immediate annuities, SPIAs, right? And fixed index annuities. If you want to hear an in-depth breakdown of annuities, of all the common types of annuities, including the pros and cons of each, go back and check out the podcast version of our show. It's episode 3. Go to Spotify and just search for Coasting and Retirement. We spend a whole hour on dissecting annuities. So let's start with deferred income annuities. These are going to be the most pension-like of annuity options. In fact, a lot of people don't realize many pension payouts are facilitated through an insurance company. When you make in a deferred income annuity, when you make a contribution or multiple contributions, typically those are called premium payments, you make it over a certain period of time, and then the income start date is deferred until some either predetermined time in the future or when you decide to start taking income out of the annuity, typically in retirement. You don't have a lot of control in this situation. When you turn your premium over to the insurance company by contract, it is used in the income calculation, and typically the amount of income once set will stay the same. That's why regular listeners of the show will know that when we talk about deferred income annuities, we have to make sure that we take a very close look at inflation, particularly with all the inflation that we've had here recently. Next up is immediate income annuities. Again, SPIAs, single premium immediate annuities. These are similar to deferred income annuities, except they typically involve, a SPIA typically involves paying a single premium, and just from experience, it's usually a pretty decent chunk of cash. And you pay it in one time, and then the income can pretty much start instantly. There's usually some type of waiting period before it kicks in, but it kicks in relatively quickly. In this type of arrangement, you definitely lose control of your premium as you would with a deferred income annuity. And just like a deferred income annuity, you got to be kind of careful with inflation. Not saying there's anything good, bad, or indifferent about deferred or immediate annuities. It's just one of the things that has to be part of the calculations, part of a financial plan, is looking at how they are going to deal with inflation. All right, next up in our specific list, if you will, of annuities is fixed index annuities. Now, these are definitely the most popular annuity among, or let me back up. That's a strong statement. My opinion is that these are the most popular annuity products among insurance companies right now and producers. Basically, how it works is the insurance company will generally track an index, say the S&P 500, just for an example. And what they'll do is they'll give you a cap rate on the gain of that index. So if the S&P goes up 12%, your cap's 8%, you get to participate up to a certain level, no more than 8%, in exchange for what's called a 0% floor. If you've ever heard anybody say zero is your hero when they're talking about annuities, and they're talking about fixed index annuity. These fixed index annuities often have long surrender periods. They tend to do have some high fees and high commissions, so they do need to be looked at carefully. But to be fair, most have some type of an attractive income rider. And with, the selling feature of this is basically you get to participate in some market upside. You're just tracking the index. You're not actually invested in the market, but you're tracking a picked index without having the bottom drop out, with the 0% floor, if you will. The bottom line in all that is if you're looking to incorporate annuities into your financial plan, then it definitely needs to be done with appropriate education, with your eyes wide open as to what you're getting into. We do use annuities in our practice for generating retirement income, but it's done with a very specific purpose every time. We are very happy to help you dissect and understand any annuities that you might be considering buying or looking at or being sold in some cases. If you want to, if you have questions about that, just give us a call, 251-333-5151, and you can set up a no obligation, no cost appointment. You can also find our contact info on gulfcoastfa.com. That's our website. That's GULFCOAST, FA as in financialadvisor.com. All right, next up in our list of 3 out of 5, covering the first 3 today, catch next 2 next week, are REITs, or real estate investment trusts. There's 2 broad types of REITs. There's publicly traded, and then there's non-traded, or referred to as private. Publicly traded REITs are often traded on a well-known securities exchange, Investors may buy and sell publicly traded REITs very similar in the way that they buy and sell publicly traded stocks during a trading session. And really the main point, why do investors hold REITs is to generate income via dividends, and not always, but as often part of their retirement. So my experience, REITs can be attractive to investors because they offer the opportunity to earn this kind of dividend-based income from real estate without actually having to own and maintain any of the properties. So in other words, investors don't have to invest their money and their time directly into buying a property, which any of y'all that have done real estate investing, you very well know this can lead to surprise with expenses. It can lead to sometimes headaches and sometimes endless headaches. It's a way to have kind of hands-off real estate investment, if you will. Common REIT holdings are going to be like apartment buildings, healthcare facilities, hotels, office buildings. I mean, even the self-storage buildings you see popping up all over the place, including here in Baldwin County, Alabama. There's the publicly traded and non-traded. They share a lot of similarities, but there are definitely different risks associated with each type, particularly for non-traded. You're going to have some liquidity and cash flow risk because you're just not going to have a ton of control over the REIT, particularly if you are trying to sell one and move on. Again, personal experience from my practice, I see it. They don't go south all the time, but there are a handful that when they went south, it got pretty ugly pretty quick on non-traded. Additionally, non-traded, they tend to be fairly expensive compared to their traded brethren. And, when I say expensive, that means they typically get some pretty hefty fees associated with it. There's a lot of hands in the pie, if you will. So when you say that, you can say generally that publicly traded REITs have less inherent risk than non-traded, but there's still risk. The biggest risk to REITs structurally is when interest rates rise. Recently. Which what it does, it tamps down demand for the REITs because investors typically opt in for safer income plays, such as U.S. Treasuries. And just as if you'd own the properties directly, there's always inherent risk in investment real estate. I can tell you that from personal experience. Just think about what has happened to so many indoor shopping malls over the last 10 to 15 years as a specific example. So, all right, now one last little note on the non-traded REITs, because it sounds like I'm just beating up on them. There has been some developments in non-traded REITs in the exchanges that allow people to buy and sell them. You will hear us discuss that more later in this episode. So if you're listening right now and you've got a non-traded REIT and you're not very happy with it, please stay tuned. All right, so folks, we covered the first 3 of our 5-part list of ways for folks to generate income in retirement. Those were using total return style investment portfolio, purchasing an annuity, and utilizing REITs. We'll pick up on laddering strategies and rental properties next week. So as you've heard this list, if you have questions or concerns about your current investment strategy, or you're just not comfortable doing it yourself, I would like to remind you that Gulf Coast Financial Advisors, there in Fairhope, Alabama, we offer both investment management and comprehensive financial planning services. For those new to the show, and particularly if you're in or near retirement, here's our basic process that we lay out every week. First, we figure out how much you'll need for the retirement you've been dreaming about. Next, we'll uncover the main risks posing a threat to your retirement, including inflation, stock market volatility, potential tax increases, skyrocketing healthcare costs, et cetera, et cetera. Then we're going to discuss options for generating income in retirement. Point of the show, and putting your investment portfolio to work doing specific jobs such as battling inflation and longevity. And finally, we're going to discuss how to keep your current standard of living in retirement even as costs keep rising. We definitely have seen that lately. So these strategies we use are designed in part to help you with income production as well as inflation and longevity risks. Really what we're trying to do is match your risk tolerance with your investment holdings and your goals. We want to make sure that you do not end up outliving your money, right? The old joke that I hope the last check bounces on my way out the door. That's kind of funny, kind of cute, but it's not a very good strategy. If you're interested in having this conversation, again, why don't you give us a call at 251-333-5151 or find us at our website at gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast like the name in the show, Coast in Retirement, FA as in financialadvisor.com. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance. Every week, Michelle and I scour the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those in or near retirement. So I want you to join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned.
Hi, I'm Michelle from Coasting in Retirement, a show that you might have heard on Sundays at noon.
If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201, College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. As we discussed before the break, every week, Michelle and I scour the interwebs, her word, for helpful financial articles related to our topic of the day, particularly articles that pertain to those in or near retirement. So Coasting in Retirement's co-host Michelle and I are going to help you all understand and hopefully decipher the deeper meaning of some of these headlines, or at the very least, we will provide some context. So without further ado, here's Michelle with the news of the week.
All right, Josh, we're going to start with a new site we found called Bankrate. This article is titled, quote, "A Retiree's Guide to Hosting on Airbnb," unquote. So this article states that the average Airbnb investors made $13,800 during 2021. I actually did some further digging, and it appears this number jumps around a little bit on different sites. But, as it were, all available data still points to the fact that Airbnb can be a viable source of rental income. And I can say that I've hosted an Airbnb in the past and found that it worked reasonably well. And what do you think about this as it relates to investors interested in rental income for retirement?
Well, very good. So, Michelle, this ties into our fifth point that we made about how to generate income in retirement. But let's take a step back. Let's talk about the quote-unquote old way of being a landlord. So you've got some experience with being an Airbnb. I've got some experience with being a landlord. So a residential, single-family residential landlord plus a commercial landlord. Let's start with this. In the old way of being a landlord, you bought a property. We'll use single-family residential for the example. Probably you fixed it up. You found a renter. You were hoping that person would rent it for at least a year, if not longer. You kind of crossed your fingers on the type of renter they would be. And then all too often you watched the renter inflict some wear and tear on the property. And then, sometimes in some occasions you had to occasionally chase the rent check. Not that this still doesn't happen for small landlords, but two things have developed, particularly over the past 10 years, and really three things that make being a real estate investor much more realistic for the average person. First, tech has allowed the average landlord to not only do a deep dive on someone's background, probably deeper than we're all comfortable with, but they can, but to also put in systems where their relationship with the tenant can be at arm's length to some degree, because that's usually a lot of the problem. Again, this personal experience, you get a little too attached to the renter, you let them slide on some stuff, and next thing you know, everything's kind of going to heck in a handbasket. Two, real estate management companies have sprung up to serve in the landlord capacity for investors. There are many management companies, especially down our part of the Gulf Coast, that will come in. If you've got a rental property, they will come in and make sure the maintenance is done, make sure they collect the check, handle the day-to-day activities or issues with the tenant, so on and so forth. Now, when you do that, you do give up a bite of the apple, the rental income apple, but often when they handle the everyday tenant problems for you, the management company, it takes a significant burden off your back. And then three, the bonus one, if you will, for folks that are in areas that allow it, as Michelle's previous experience did, particularly vacation destinations like our part of the Gulf Coast, sites like Airbnb and VRBO and the like have completely changed the income potential of owning a rental unit. What I mean by that, you can rent a property for some set amount of dollars per month. If you're in the right area, and again, if the area allows it and you have enough demand, you can 2 times, 3 times, maybe 4 times, whatever the number is, that steady income, you can go up above and beyond with folks that are willing to pay a little bit of a premium to have that property for a long weekend, for the week, wherever it may be. And that has really, really changed the status, in my opinion. Having been a landlord 20 years ago, I am way more comfortable jumping back into that market now than I was back then. If you'd asked me 20 years ago if I wanted to be a landlord again, right off the bat, I'd said, heck no. Now, as we're getting back into those types of things, we definitely are much more comfortable because there's much more structure in place. So that's a great article, Michelle. What you got next?
Okay. And I will say it was easy to
Yeah,
sign up for
yours
Airbnb.
was a great one, right?
Yeah.
And we use it on the buyer side.
Yeah, and it was easy to sign up through Airbnb and Vrbo and all those stuff, and I did mine, and I had local baskets, welcome baskets, which the article goes into suggesting, so that
Very
went
good.
far, I think, so I was a super host.
You were a super host.
Yes.
Still a
Well,
super
actually,
host in my
Airbnb,
eyes.
according to Airbnb, I was a super host.
Very good.
And I've stayed at some not so great Airbnbs too.
Yeah, I hear you.
And I've been vocal about it. So, okay. So next up is back to our buddy Investopedia.
Yes.
Investopedia.
You like that? Kind
It
of
is
by
a lot of
vowel
syllables.
pad.
I like it. Their site has a recent article titled 4 Sources of Income for Your Retirement. What, Investopedia? It's supposed to be odd numbers. And since I go off on tangents about this, I actually did some additional research and looked into the psychology of numbers.
Okay.
And some nerdler is also hung up on odd numbers and did all this research across the world in different countries and whatnot. And he said 49% of the people he asked like the number 7 the best.
Like number 7 the best.
They were all odd numbers. He asked them 1 through 10. 5's too easy because it's in the middle. Hardly anybody picked evens. 49% overwhelmingly 7. And when you think about it, it's kind of ingrained in us. There's 7 continents. There's 7 senses. There's 7 natural wonders of the world. So I'm just saying, Investopedia, we need to write them a little memo to let them know.
I like it. And
I
if
mean,
my
5
mom's
just
listening,
sounds cool too.
Yeah.
You know, 5 instead of 4.
that's right.
Yeah.
Well, if my mom's listening, the math consultant, she's thrilled because she's all about numbers and all that stuff. So, well, what did the article say?
Okay, well, it reads 4, but we know how I feel about that. So it reads 4 ways to generate income in retirement, and it gives more options than 4, which is good, even though it's called 4 sources. That said, this article discussed a concept you discussed in the opening, systematically laddering CDs.
Certificates of deposit.
Yes, not compact discs.
Right.
Takes me a while to get used to that. So, I actually did kind of do this back in my 30s.
Okay.
And I did the laddering one.
So just a couple years ago is what you're saying.
Totes, right. So I did that. I don't currently have any CDs that I'm aware of. If I do, they've definitely matured and they're in the safe somewhere. But anyway, but can you explain more about laddering, not compact discs, but certificates of deposit, please?
Nope, absolutely. So first, let's do this. Let's describe the 2 broad types of certificates of deposits, which we'll refer to as CDs at this point, not the music type. The first type is a bank CD. That's typically what people think about when they refer to a CD. That's where you go in, you buy a CD for a certain time period in exchange for a guaranteed interest rate from the bank. They are typically, as long as the bank is FDIC insured, they're going to be FDIC insured up to $250,000. Wow, I'm struggling with that. Overbite.
FDIC.
Thank you. FDIC?
No, not INC. No N.
Well, I like my version better. But okay, so FDIC insured up to $250,000 as long as it's an FDIC insured bank, right? Thank you. Which I believe most banks are at this point. Brokerage CDs are sold through brokers and/or broker dealers, which, just to be honest with the listeners, I don't have my FINRA registration anymore. I don't affiliate with broker dealers, so I don't do brokerage CDs anymore. Either way, they look, smell, and taste pretty similar. The ones that you buy through a brokerage, as long as the brokerage is partnering with a federally insured bank, they will still have the same FDIC coverage up to $250,000. But you definitely want to check the fine print on that if you are buying a brokerage CD. Make sure that the underlying company the underlying bank that is servicing it has that insurance. So so that's first. Second, let's compare rates over the past, say, 20, 30 years with current rates. Per annuityexpertadvice.com. That's a site that you and I have referenced before. He calls himself the annuity expert. Good for him. The average rate of a CD in the early 1980s, when we were just babies, was 12%. And I think it actually, in many cases, it probably went higher than that. either way, this rate started decreasing over the ensuing decades, in large part because of good things, if you will. Inflation remained pretty mild during that time period. Once we got past the early 80s, we got mid 80s and later, interest rates were easing, and really we had a almost historical period of historically low interest rates. Well, what happened is CDs in the early 2000s, the interest rates that they would offer started to rapidly decrease until we entered a period during this past decade where CD rates were not that attractive, say 1% to 2%. So again, we are recording this February 2023. Everybody kind of has an idea what's going on with inflation, what's going on with interest rates. CDs are now kind of back on the mind of investors. In fact, Michelle, I did just a brief Google search because, again, I don't deal with CDs too much other than on the retail side for myself, if you will. But Capital One is offering 5% on one of their CDs. So what people are doing, again, now, what they used to do in the past, they would buy CDs in a ladder system. All that means is you had the CDs maturing at different time periods. That way you did not have all of your money locked up at one time. You create a little bit of liquidity. And back when CD rates were pretty attractive, particularly in the 80s, this was a great way to generate income in retirement. It's been a terrible way to generate income in retirement over the past decade or so up until now. And again, it's one of those things, it's a double-sided coin because, yes, it's great for retirees that the CD rates are higher, but it's kind of rough on the rest of the economy that interest rates are higher as well. They go hand in hand. So that's a great find. All right, what you got next?
Okay, we're going to pivot to Forbes. And Forbes has an article titled How to Create a Paycheck for Retirement. And this article discusses single premium immediate annuities, which goes by my favorite acronym, SPIA.
Very good. SPIAs.
Yes. And I think I need a SPIA because you'll tell us about it, but they have consistent payouts. I don't have any heirs. Who cares? And then you can buy and pay more money up front for inflation is what I learned. So anyway, but SPIA. So my guess is that the part I want to discuss probably hurts the average investor's brain a little because it certainly hurt mine. So Forbes lays out the difference between interest and dividend investing and total return investing. And it seems like these two concepts have a bit of overlap. But what are the primary difference between the two, and why does this matter to investors in retirement?
All right, so we touched on this in the opening segment, but let's go ahead and rehash it. Let's start by using just a general investment account to generate income in retirement. What you mentioned, Michelle, there's two broad ways of doing this. The first is generally referred to as interest and dividend investing. The idea is to create interest from bond investments and hopefully dividend payments from stocks that can distribute corporate profits or distribute dividends. The goal with this type of investing is to set up consistent payouts on a monthly, quarterly basis, whatever the investor needs, with hopefully not having to sell the underlying investments that generate the income. The issue and what they discuss a little bit at length there in that Forbes, that's Forbes, right? Mm-hmm. Yeah, the Forbes article is with interest and dividend investing. First, it takes a pretty good chunk of change to generate a high payout. Especially with bond yields, again, we're in a little bit of a unique period compared to the last 10 to 15 years. Bond yields go up with interest. So last 10, 15 years, for the majority of the time, bond yields were not great. It was scratch and claw to generate yield. You got higher interest rates, you got higher bond yields. It's becoming a little bit more attractive again. But you couple that with if interest rates start going down, if inflation goes down, then we'll be back in a scratch and claw situation on bond yields. Now, if you add in the dividends from the stocks, remember bonds are a debt type of instrument. You're lending the government, you're lending a municipality. That's a big word I have a hard time with because of my overbite. You're lending a corporation money in exchange for some type of interest, the yield. On the flip side of that, dividends are related to stocks. They are going to be things where they are paying out some of the profits that they generate, as long as they are a company that is in a dividend producing mode. Typically, growth companies like tech companies are going to keep their capital in house because they're going to reinvest it. Dividends usually are a little bit more blue blood, if you will. Think Ford, think car manufacturers, think Walmart, things like that. Companies, even with that said, companies like that will cut or eliminate dividend payments during rough economic patches. They will circle the wagons, if you will. And what happens often is investors will start hunting for yield in that situation, which is why that we use the dividend and interest part of the portfolio. Fine. It's kind of an old school way, if you will. what I consider, and I consider alone, this may or may not agree with the rest of the market, but I consider what is an evolution of that strategy is called total return approach. Total return approach is basically a fancy way of describing a diversified portfolio of stock and bond funds. The goal is part of your portfolio is generating the income, like we talked about with the dividend interest, but also the other part is hopefully generating some room for capital appreciation, which matters to the longevity of said portfolio. Because remember, the retirement spending rules that you've heard many advisors and commentators mention, the 4% withdrawal rule, that is based on total return investing, not dividend and income investing. Good job, Forbes, and good job, Michelle. What's next?
Okay, so now we're going to pivot to Fidelity's site, but before we get into the article, remind us, isn't Fidelity one of your custodians that you use?
Well, it is, yeah. So custodian is a fancy way of saying where is the money housed. We use Fidelity. We also use Charles Schwab. We're pretty agnostic as to which one a investor or client will pick, but I will tell you not to pick on Fidelity. They tend to nickel and dime a little bit more than Schwab. Schwab, if I understand correctly, if I remember correctly from my history lesson from all my teachings, came along and was the first quote-unquote discount brokerage, and they kept the fees low, and you kind of see that has played out over time. So yes, you're 100% accurate, Michelle.
All right, cool. So sounds good. Now, onto the Fidelity article, very simply titled Retirement Income Strategies, which I note also had 4 strategies as opposed to 5. So anyway, this article has a lot of information that collaborates with some of our other headline articles. So let's focus on the part where Fidelity discusses having an investment portfolio with guarantees. What do they mean by the guarantee part?
Okay, well, I'll hit this one pretty quick because what Fidelity undoubtedly is referring to here is how a lot of times when you are looking for a guarantee part of an investor's or retiree's portfolio, you're wanting to point towards things like Social Security. You're wanting to point, well, I say that we're one day removed from the State of the Union, and that was an interesting conversation about Social Security for sure. But anyway, back to the main point, you're wanting to point to things that are at least somewhat, to some degree, you can look at and say, okay, this is a guaranteed part of my investment portfolio for income production. Social Security, pensions, and then in Fidelity's case, they're talking about annuities, which we've talked about at length in this episode, right?
Our friend annuities.
Yeah, income annuities. Now, understand, investors, listeners, that for an insurance-backed annuity, it is the payment, the guarantee of the payment coming is only tied to the ability and willingness of the insurance company to make said payment. Now, that said, most insurance companies that play in this market are pretty large, pretty huge actually, and globally, and they have a long track record of meeting the promises that they give on an income annuity. But so what they're talking about is having an investment portfolio with guarantees. It kind of goes back to the bucket thing where this would fall into the income bucket, what Fidelity is referring to as a guaranteed part. So very good. Good job, Fidelity, and good job, Michelle. We got one more?
Yes, we do. Okay, back to those fools at Motley. And it is Mardi Gras time, so we have jesters running about amongst us all over the place. So I'm glad we included them. So also, it is called Motley Fool.
Is it Motley Crue?
Yeah, I wish it was Motley Crue.
The second greatest hair metal band after Winger. They probably could have used the Motley Fool back
in the day because I think they blew a lot of their stuff back in the 80s and early 90s.
They definitely needed a financial advisor.
And some other advisors. Yeah. Okay. So Motley Fool has an article titled, what is it? 8 Best Strategies for Retirement Income. Turns out Motley Fool are a whole bunch of fools. Just kidding. But odd numbers are better. Please listen to the first thing about the psychology of numbers. Okay. So there are 2 parts I want to discuss about this article. First, they discuss delaying Social Security to maximize the payout, which sounds good to me. But second, and this has come up before, they discuss working a part-time job in retirement. No, thank you. I don't like that part at all, but I wanted to hear your take on both of them. And also on, when I read this article, it had 2 very nice older people on a very nice boat.
There you go. Yeah.
So that encouraged me even more. So I did power through the 8, not 9. Best strategies for retirement income.
Very good.
To get up on a boat.
Well, let's talk about the first part, the Social Security. So anyone that has looked at their Social Security projection statement knows that the benefit gets higher every year they delay taking Social Security. What most folks don't know, Michelle, is that once you reach full retirement age, and that's typically between age 65 to 67, you get an extra 2/3 of 1% for each month you delay after your birthday month. The simple math on that is adds up to 8% increase for each full year you wait until age 70. So I've said this before, it's just my opinion. This is the only, and I mean the only investment you can kind of squint at and say it gives you a guaranteed 8% return if you can just hang on and not put your hands in the cookie jar. Now, here's the thing. It's not that simple. And as we've said so many times on this show, nothing in investing is guaranteed, even when it comes to the government. But when you add in the fact that Social Security also has to accommodate cost of living adjustments, there's typically a tipping point to where the additional benefits from waiting will mathematically outweigh the payments received from starting Social Security earlier. All right. So that's the first answer or first comment I have on the article you found. Now the second one, that's a little bit more squishy. Compare and contrast those that want to work part-time in retirement versus those that don't. I'm pointing at somebody right now, Michelle. She's done. When she retires, that's it. She's out.
Like, I want it to be next week, but that's not bloody likely. But
we're somebody.
I don't want to be 65. I don't want to work till I'm 65.
I hear you. Right. And so, and some people retire and they get a little fidgety and they go back to work. And then some people have to do some part-time stuff to meet their income needs or to get access to certain benefits. Either way, what they're trying to say in this article is kind of keep your options open and also pay attention closely to your Social Security projections. Try to do what you can to maximize the timing and the value of that. Delaying it's not for everybody because you could delay it to age 69 and lo and behold you turn around and you die at age 70, right? So there's conversation being had there. But some folks will tie this into our real estate investment conversation, Michelle. Some people's part-time job might just be simply maintaining an investment property or properties. So great job.
Paying somebody else to do it.
Paying somebody else to do it. Great job, Motley Fool.
Mardi Gras.
Mardi Gras, all right. Well, Michelle, great job as always with the headlines. These are all important pieces of information that impacts our listeners.
Buckets and ladders, buckets and ladders.
There you go. For our listeners that want to have a little bit more discussion about these topics and interested in learning more about our strategies, why don't you contact us at Gulf Coast Financial Advisors at 251-333-5151 or find us online at gulfcoastfa.com. All right, folks, coming up after the break, we get to have a little fun, and undoubtedly I'll get picked on yet again a little bit by my co-host Michelle. Indeed. In our next segment, we call it Where Josh Nailed It, where Josh was a little off. And so let me provide a little context. I've always had pretty strong opinions, and I can prove it. My son Peyton recently dug up some old English writing papers that I wrote back in high school.
Why Josh still has those, no one knows.
Because I'm proud of what I said. So I wrote those when I was his age now. And I do come off a little precocious, but I wasn't always wrong, mind you. I'm actually proud of some of the things I believed in coming up on 30 years ago in high school. So the point of that is we're going to go back. We're not going back 30 years on those opinions, good Lord. But we are going to go back a few years. We're going to share some opinions I've made public as an adult. And some of those opinions proved fairly accurate, and for balance, some of them were, I didn't quite stick the landing because I am human. So see you after the break for Where Josh Nailed It, where Josh was a little off.
Hi, Michelle here. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast Financial Advisors a call today and schedule your no-obligation in-person review with Josh and his team. Maybe it's time for that second opinion. Make sure to call 251-333-5151 or visit us on the web at gulfcoastfa.com. That's GULFCOASTFA as in financial advice.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
All right, welcome back. So the point of Coasting in Retirement is to offer general financial guidance and education to those in or near retirement, which means I often give my professional opinion. So as I've stated previously, I'm proud of the thought, care, and due diligence that I put into giving said professional opinion, both on this show and in my financial planning practice, but I'm also human, and which means that I don't always stick the landing and I'm always learning and evolving. So each week, Michelle and I, we get to poke a little fun at myself by admitting any thoughts or opinions I put out there that weren't 100% on point. but also to be fair, pointing to some of the things that were pretty accurate. I'm not a soothsayer, but sometimes I have
Not
some
yet.
opinion. Not yet. So we call this segment where Josh nailed it, where Josh was a little off. All right, Michelle, what's first?
Okay. Josh, you say that even though you were just a youngster in the early 80s, you still paid attention to interest rates because, one, you've always been a nerd.
Truth.
And two, your dad was in construction. You paid attention to the rates he was getting on construction and equipment loans. I don't completely buy that because that sounds so not riveting for a child, but you can...
See point number one.
Okay.
Nerd.
I will let you try to convince me otherwise. So, having lived through that time period, albeit just a wee person, you stated publicly that you didn't see how there was any way both inflation and interest rates would rise to the levels of the late 1970s and early 80s. So, did you nail it on this opinion, or were you just a wee bit off?
Well, all right, so context, Michelle, as bad as the inflation conversation has gotten over the past few months.
That's all Henry talks about.
Right. It's eased up a little bit, but it's still lingering out there. And even as high as the bank and brokerage CD interest rate offerings have become, as of today, when we're recording this, February 2023, happy Mardi Gras, everybody, we are still nowhere close to both the inflation rate or bank interest rates from that time period for late 70s, early 80s. And again, I referenced this in the previous segment. The annuity expert site, bank CD interest rates averaged about 12% in the early 80s. So the point of that is, even with that, even what we're saying, first, yes, I nailed it so far, because the highest rate I could find through a simple Google search was Capital One offering 5% on the CDs. Inflation is still not as high as it was during that time period. Interest rates are still not as high as they were during that time period. And here's my opinion, Michelle. Forgive me if I go off the reservation a little bit, but I don't remember the particular years before you and I were born. I want to say it's 1973. Some of our listeners that were alive during that time period can tell me, but the United States came off the gold standard. And one of the
Wizard of Oz.
Right. And one of the key things that they were really worried about was inflation. Well, guess what? They were
Here we
right.
are.
Right. And again, I'm going to show my age a little bit because I was just a kid. Even though I was paying attention to my dad's construction notes, I wasn't paying attention to government as much. But we had a Federal Reserve that came in and basically broke the back of inflation. And that's what you saw with that. So the point of that, fast forward to today, I feel like things are a little bit more in tune. Not that I totally agree with how they handled it. I think they should have jumped on the inflation earlier. And I think also government was a big reason why the inflation problem was caused from the beginning. However, I've held that I don't think it'll get as bad as the late 70s or early 80s. And so far, I have nailed it on that.
All right. Well, this is an opinion I've heard you express multiple times, both privately and publicly. While annuities can be a useful tool to generate income in retirement, they are not the end-all, be-all, and should be researched thoroughly and purchased carefully. You seem to have a particular sore spot for salespeople that try to hoover up most, if not all, of the available assets an investor may have. So in sum, annuities, not the golden ticket, they are sometimes made out to be. Are they or are they not?
I nailed her a little off.
Yeah.
Nailed it. So here's the thing. Unlike my previous landlord real estate investment opinion, this is an opinion that I don't see myself ever really deviating from. Let me give you some context. Someone could hear me just make that statement or respond to what you said, Michelle, and they could lump me in with all the other commentators out there saying that, quote unquote, all annuities are bad. I would encourage our listeners to go back to our episode 3. You can find it on Spotify by searching Coasting Retirement. And you can hear me explain why slapping this broad of a statement on all annuities is really silly at best and disingenuous at worst. The annuities, there are very different types of annuities. They all have different purposes. Some of them bleed over into the others. Deferred annuity, SPIAs, which is one of Michelle's favorite type, or favorite type to say anyway. SPIA, right? So really what irritates me, and I try not to pick on my brethren, some of them do a really good job, but definitely what you will see out there is someone will come in and on an investment portfolio, they will take a significant amount of the assets available and stick them into an annuity and tell them that they got nothing to worry about. That everything's going to be taken care of. These, and even you and I, Michelle, in past episodes have picked on some of the advertising on said annuities. Guaranteed 8.5% return, which is just it bothers me that that's even allowed to be put in print. Right. So my thing is, that's not the golden ticket. They have a purpose. call me the split the baby guy. We do use them, but we use them for a very specific reason, and we always have investors walking in completely wide-eyed on what they're getting into, the pros and the cons. And we definitely don't sit there and do the carnival barking thing where we're selling a particular product as the golden ticket that's going to solve all your financial woes. Because that, honestly, listeners, that product doesn't exist. It never has and never will. Right. So, all right, Michelle, you got one more?
We do. Okay, you stated before that just like with annuities, REITs,
real estate investment trusts,
that's right, are an investment choice that should be researched before being bought. To get into the weeds a little further, you've directed this commentary specifically towards non-traded REITs. Can you explain your opinion a little more in depth and let us know if you nailed it or were you a little bit off?
Okay. Well, I think this one is definitely where I've been a little bit of both, to be fair. So we're not going to go through the whole REIT dissertation. We did that in a previous segment. We will give you a little bit of pros and cons. Traded REITs in general are going to be traded on an exchange, and they have at least some version of liquidity versus non-traded REITs, which, again, there's a purpose for them. It's not that they are a bad product per se, but there are definitely some things that investors need to know about before they walk into a non-traded REIT. Primarily, you're losing quite a bit of control with the capital that you're putting into a non-traded REIT. And it's not every time, but there are instances where the payout from the REIT maybe is reduced. The value of the REIT can go down significantly if the underlying assets in said REIT go down significantly. The example we've always used in the past has been with enclosed shopping malls. Probably not a great business to be in right now, except maybe for some particular markets. But on the flip side of that, Michelle, what has happened, and I don't know exactly what year because it just came on my radar a couple of years ago, but there is a rise of exchanges that help people get out of or buy and sell non-traded REITs. The one that I use that the investment company that I work with has given us the ability to work with is called Realto.ai. That's REALTO.ai. And it's not a perfect system necessarily because there still has to be a buyer on the other side. And if you've got a non-traded REIT that's damaged enough, it's going to be hard to find buyers. However, it does at least provide the ability to get some liquidity if you're in a non-traded REIT that is just not doing what you need it to do. So in that particular situation, Michelle, I probably both nailed it down. I'm splitting the baby on that one, right? So, all right. So listeners, once again, great job, Michelle. Thank you.
You're welcome.
Didn't pick on me too bad. Kip Winger's probably a little hurt, but he'll get over it. He and his millions he made in the 80s. I think he's still alive. I think he's still playing music. Progressive.
Lord help us.
That's right. All right, listeners, once again, as you heard, I totally didn't nail it on everything, but I think I had valid reasons when I was being a little off. I am learning to be more open-minded. I would say impressive maturity, wouldn't you say?
Yeah. Okay, I like that.
You like that? All right,
yes.
Very good. Well, to our listeners that heard us discuss something that impacts them, particularly those of you in or near retirement, remember, you can reach out to us at Gulf Coast Financial Advisors to start a conversation. Call us at 251-333-5151, or you can find us on our website at gulfcoastfa.com. That's GULFCOAST. FA is in financialadvisor.com. Thank you to my lovely co-host, Michelle Lee Melton. Michelle, great job.
Thank you. You're welcome.
The crowd is cheering for you.
Crowd goes wild.
That's right. I want to give a thank you to our awesome radio station, 106.5 FM. That's Talk 106.5 FM. They're over in Mobile. Many thanks to the provider of our show music, local band Sloth Racer. That's Sloth like the animal. You can find them at slothracerband.com. And as always, my sincere appreciation for all of you out there that have been listening and joining Michelle and I on this journey. We'd love to be a part of your journey as well. Until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.